The financial system is sick due to a major collateral shortage, and now financial conditions are starting to tighten. The Fed is completely unprepared to deal with another recession, and I'm going to show you how things are about to get even worse. All that and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. I want to dig deeper into this collateral shortage because the financial system is very weak right now and is not able to deal with another economic downturn. Now, I know a lot of people are not predicting that, but I want to look at how things are about to get worse before they get better. And if the economy does roll over into a recession, I want to show you how the Fed is in no position to deal with it. They're completely unprepared. We've actually heard Treasury Secretary Janet Yellen call for higher interest rates, which some people think she's got a lever on her wall to make rates go up. That is not how it works. We've heard Powell want higher interest rates, and even he expressed concern over another recession in his most recent FOMC press conference. So let's dig deeper into this because I have some further insight on why QE seems to still be the only solution, even though it's not the right solution. It's a temporary solution that's only going to make things worse. But there's some other things that are going to make things worse. So let's look into the data here. Let's start with the reverse repo. A number of questions came in on this, and so let's explain what this is. So this is an overnight loan of Treasury securities in exchange for cash. And today, for the weekend, $747.121 billion was borrowed at a rate of 0.05%, or what is referred to as 5 basis points. So what is going on in this operation is you have people that have cash that are loaning that cash to the Fed. The Fed is then giving them some Treasury securities, and the Fed is paying them 0.05%. Now, one of the confusing things about this is what happens if there's a dividend paid on the bond? Who gets it? Well, it goes to the owner, which is the Fed. So the Fed has a huge balance sheet of many trillions of dollars worth of bonds, and they are loaning them in an overnight fashion. So that if the person lending the cash needs an overnight asset and they can't get one, well, the Fed can give them anything, any form of Treasury security, because it comes back the next day. So even a 30-year Treasury security in that manner acts as an overnight asset because it has to come back to the Fed the next day. It's an overnight loan, and people are getting paid 0.05% to loan their cash to the Fed. And that's why as soon as that announcement happened, the next day, what happened? The repo usage straight up because people said, hey, I've got a lot of cash I'm making nothing on. I'd much prefer to have a Treasury security. Oh, and I'd like to have that 5 basis point return. So what you're seeing is an overnight loan. Now let's look into kind of how this is becoming a problem and where it came from. So let's first start with all this cash. So here we have cash assets at all commercial banks in red, and this is the overnight reserve repurchase agreements in blue. And so you can see that as cash in the banks is going up, well, all of a sudden the need to do these reverse repo loans went up because the banks have too much cash. This is exactly what we've been seeing the problem is. And as cash went down, the need for those overnight repo loans started to go down, and then as cash kind of went up a little bit, the repo needs went up, reverse repo needs went up, and then as cash started to go back down, well, then the need for these overnight loans went away. And it makes sense that they would go away because over time, the U.S. Treasury will eventually issue enough of the collateral the banks want, and the problem will go away. It just is a matter of how long it takes and what collateral the banks want. And then all of a sudden the pandemic happens. So let's go back and look. Cash goes up due to stimulus. Repo problem goes up, and then it kind of disappears. And it goes away for a while as if it's not even a factor. And banks were sitting on all this cash and didn't have a problem with it. But all of a sudden, big problem. Repo loans are blasting higher, off the charts, record all-time high demand. And yet cash didn't go up that much. So what happened was the next chart here, and what we're seeing is what's called the Treasury General Account in blue, and this is the checking account of the U.S. government. And so as this cash went, or as the Treasury borrowed more money, they issued a lot of T-bills. And guess what? The banks needed T-bills. And so all of a sudden that problem with the overnight repo goes away, because all of this cash is sitting in the Treasury account and they issued a whole bunch of T-bills. Well, now all of a sudden, you'll notice the Treasury General account is going down. It's going down quite a bit. And let's talk about why that is, because this is important to understand. We'll go back to the chart so you can see this in a moment. But I believe it was the CARES Act that allowed the Treasury to borrow a whole lot more money. And former Treasury Secretary Steven Van Metre said, yeah, let's do it. Rates were really low at the time. They actually dipped negative, and he borrowed a whole ton of money. And so that issued a bunch of T-bills, pulled a whole bunch of money into the Treasury account, and everything seemed to work out. Banks had the collateral they wanted, and the cash was sitting at the Treasury. So everything was cool. Now, you've seen a lot of people, or you've heard a lot of people talk about how the unwind of the TGA is going to be super inflationary and drive interest rates up. Yeah, so far that hasn't happened. But I want you to keep in mind is why is this drawdown an issue is because those T-bills that were backing that cash are getting rolled off. So now all of a sudden we have this major collateral shortage and thus a spike in the repo. So the banks are needing very short-term assets to back the cash. We'll talk about that in a moment. And they don't have it, so they go to the Fed, who creates an overnight assets through the repo system. And that way the Fed can lend virtually any asset it has of any length because it's getting it back the next day, solving the problem. So how is this about to get worse? Well, let me show you. Because the normal balance for the Treasury is somewhere between 200 and 400 billion. And right now it's sitting up here. And don't look to this side. You got to go way over here that we're saying around 650, 700 billion right now. So let's go to the latest Treasury announcement press release back in May and see what they had to say. So they said the Treasury is assuming a cash balance of approximately 450 billion at the expiration of the debt limit. And this is an issue because the Treasury has to bring its balance back down. So if you're wondering why is Janet Yellen doing this? She has to do it. So the provision that allowed the expansion of the TGA is now going away. So it has to be unwound. So that's why it's going down. It's not because she's choosing to, it's because she has to. So let's continue on. Based on the expected suspension on July 31st, based on the expected outflows, all right, nothing, here, Bipartisan Budget Act, nothing key there. But it's going to get worse because we can go to the sources and use table, and there's a forecast revision that came out. And if we go up to here, it says end of quarter cash balance, and we go back down, it says, instead of 450, it's going to be 300 billion instead. And where does that take things, you wonder? Let's go back. And that means this blue line, which is sitting around, say, 650, 700, is going down way back down to here. And so that's going to make that collateral shortage in the repo market even worse. Will this number break $1 billion? It probably will. It would not surprise me if it does, but now you can see the setup for that. But what's going to happen the next quarter? Well, at the moment, at the end of September, the Treasury is estimating the balance will go back up to 750 billion. You say, well, there's some relief. There is some relief, not as much as you expect because 750 is pretty much right where we're at now. So you can see that there's some problems here causing financial conditions to tighten. Now, as we get into this, why is this a problem? So why is this whole thing an issue, and why is QE the solution? And then we'll look at why QE in itself is a problem. So the Fed's got a problem, right? The banks need the short-term collateral, and nobody has it. And the Treasury is getting rid of it. So the Fed has temporarily solved it by the reverse repo operations by lending out overnight securities. But they've created a second path through QE because we've discussed in the Monday show that quantitative tightening is a logical solution here, but there's no way they can do that. And if you missed that, go back and watch Monday's show where we talk about that. So how does the Fed use QE to satisfy the bank's needs? So this is pretty interesting. When a customer deposits money at a bank, that we know, based on reports from the Treasury, that money will be there between 3 to 5 years, depending on if it's a corporate deposit or a retail customer deposit. So when that happens, the bank takes that cash, goes out and buys Treasury securities, creates what's called a bank reserve. to back that money based on the time it expects it to be there. But right now, there's a lot of cash in the banks, and the banks don't think it's going to be there 3 to 5 years. They think it's going to be there a lot less, because as people go back to work and lose their unemployment benefits, their incomes are going to go way down. And when their incomes go down and their bills start coming back in, and they have to pay on things like student loans are coming back, payments are coming back in September, there's going to be a demand for cash. So the commercial banks can't go out and say, look, we've got the normal 3 to 5 year window. That's why you're seeing so much demand at the front of the curve on the 4 and 8 week bills, because they're fairly liquid. They mature every 4 and 8 weeks. And guess what? There's not a lot of those. So the banks have a problem. They have to match these deposits, which are liabilities, with an asset. And they don't have the right assets. So they've gone to the reverse repo route and gotten an overnight asset, which seems to be satisfying the problem for the moment. But the Fed says, hey, we've got another solution that's called QE. Because what quantitative easing does is it takes that bank reserve that's created with customer deposits and it swaps it for what's called a reserve asset. Now, we've talked about how this process works. I'm not going to go into more detail on that. But the Fed announced on Wednesday that they're going to increase the interest rate on those reserve assets, which is called the IOER, interest rate on excess reserves, from 0.1% to 0.15%, essentially saying, hey, banks, do more QE. And why would they do that? Well, here's why. Those reserve assets created by the Fed, they're overnight maturity. So if you're a commercial bank and you're trying to match your assets, your liabilities with assets, and you need some assets on the very short end of the curve that mature frequently, well, a reserve asset would work because it's an overnight maturity. In fact, if you're connecting the dots, is there much of a difference between an overnight repo, repurchase agreement, reverse repo loan, and a reserve asset from QE? Doesn't look like it, does it? On paper, they look identical. They both mature overnight. So you've got a way to solve the problem. So what the Fed is doing is saying, look, we're going to raise the interest rate. We're going to encourage the banks to do more QE, because where is most of the purchase of QE being done right now? At the long end of the curve. The 10s, 20s, 30 years is where they're doing quite a bit of buying. And so what the Fed's trying to do is say, look, bank, you can't get the short-term collateral you want. We get it. It's not available. But go out and buy a 10, 20, 30-year note or bond, swap it through the QE process, go and bid on that, create some demand there, and now you've got your overnight asset. Problem solved. But QE comes with its own set of issues because it tightens financial conditions. And how do we know that? Well, we can go to the bond market and we can see right here, 30-year Treasury yields headed lower. Now, if you're seeing inflation, and you're seeing money printing, which we're not seeing money printing, you would expect, and economic growth, you expect interest rates to rise. But when they start to fall, it tells you financial conditions are tightening. And this is key. So let's go back now to see how that occurs. And we can go to the cash assets at all commercial banks. We'll put that here in blue. And the velocity of money, or how many times money is used in a transaction for a given period of time. And everyone thought this increase in cash would lead to an increase in volatility, or velocity, not volatility, increase in velocity of money. In fact, they almost look inverted. And in fact, check this out. We'll go in here and I'll show you, if we go to the cash assets, and we put a minus sign in front of this, and we hit apply, and then some magic happens. And we'll make it bigger, and you can say, wow, there is a strong relationship. As cash is going up since the great financial crisis, the amount of transactions money is being used for is falling. And that's because quantitative easing traps money in the financial system. And here you can see the money multiplier in blue headed down, indicating that the demand for money is growing more than proportional to the supply of money. And there you can see the velocity of money is headed lower. Now, a lot of people are surprised and they think the next print will be up, but the next print is likely to be down. So what you're seeing here is how the Fed is trying to deal with a very weak financial system by QE. Now, QE in itself is actually cancer to the financial system. It's bad news because, again, it traps dollars in the financial system. And based on who's holding those dollars, it's mainly two large commercial banks. So it's really trapping a lot of dollars in between two banks and go back and forth. It's not how you get the velocity up. It's not how you create inflation. And it starts to make sense what the bond market is sitting here telling you. And so the challenge the Fed is facing is they're using cancer to fight a sick financial system. And imagine that. Imagine you're in the hospital, you're very sick, and you've got something and no one knows about, none of the doctors know what to do with it. And they say, but they know where it's at. They say, here, the problem is here. And so they decide to give you cancer, hoping the cancer will go attack the sick part of you and get rid of it because they feel they can cure the cancer better than they can cure the problem. And that's where it all doesn't work. Because if you do QE for too long, it traps dollars in the financial system, drives interest rates down, and that actually leads to tighter financial conditions because if you don't have lending growth, which we're not, and that data was not updated in time for today's show, so if you don't have corresponding increase in lending growth with lower interest rates, financial conditions tighten even more. And instead of the patient getting better, the patient gets worse and rolls over into a recession. And so why is this a concern for Janet Yellen and Jay Powell is because we have no margin for error. So what is the Fed's normal game plan when the economy goes into recession? Lower the federal funds rate, right? Lower yields. And then since the great financial crisis, it's do quantitative easing, which hopefully you realize causes interest rates to go down. So if the federal funds rate is at 0 right now, and we have another recession, can the Fed lower the federal funds rate? No, they can't. They can't take a negative, which means the only next thing they can do is more QE. And based on what the collateral shortage in the front of, because we know that, we see that, where is the Fed going to do more QE? At the long end of the curve. They're going to drive long rates to the floor. And if you want to see financial conditions really tighten, well, that will do it. And how does that lead to a market crash? Well, let me show you. Because when interest rates go down, they lead stock prices, where's my stock arrow, on average, by 3 months. This is cool. Check this out. So here's 30-year Treasury yields. And now let's go in here and overlay the S&P 500. Wherever it is, there it is. And we'll zoom out to 1 year. And here you see Treasury yields peaked in mid-March. Here's the peak of the S&P 500, mid-June, 3 months later. So where do you think equity prices are going? They're going lower because financial conditions are tightening. And that, of course, is why we will proudly wear the crown today, because we see interest rates going down, financial conditions tightening. Now let's take a look at the other data because it's not suggesting that things are getting any better. So hopefully that helps you quite a bit. Let's get into the Thursday data. We'll look over at Europe. Now remember, inflation moves from countries that produce to countries that consume. Let's look at inflation. Here we have in Europe, CPI month over month slowed to 0.3%. So a disinflationary print got cut in half. Even the core, excluding food and energy, dropped from 0.5 to 0.2. So this notion that the U.S. is going to drive inflation around the world is pretty darn ridiculous. Let's take a look at the jobs data, and there's some good news here, at least down in the bottom. Total pandemic claims fell by 559, almost 560,000 to 14.8 million, suggesting that people are going back to work. But one of the problems is initial claims went up to 412,000. So while some people are going back to work, other people are losing their jobs. And we know those unemployment benefits are going away pretty soon. Now, how about the Philly Fed? This gets pretty interesting. Oh, you know what? Before we get there, I want to look at the Dallas Fed data, because this tells you there's the problem in the labor market is bigger than we think. So if you look at this, it's just released today. Employment rate declines mid-June. So the employment rate in the current population went down. Not what you want. You want to go up. So that is not good news. So let's go to the unemployment rate is saying that was unchanged. So that's good. But how about the labor force participation rate? What you want is this number to increase, because the labor force participation rate is those who are working and those who are actively seeking employment. So in a good labor market, you expect that number to go up. And the Dallas Fed says, no, it went down. So that is telling us that, hey, there's serious problems in the labor market that we can't even see here that may not show up until the next non-farm payroll report. Let's go on to the Philly Fed, because even here we see the Philly Fed manufacturing survey peaked last month. But let's take a look at the diffusion data. And this represents a percentage of firms increasing minus the percentage of firms decreasing. So what is your general level of business activity? It was about the same. So 31.5 where the peak was, down to 30.7 firms saying there's an increase in activity. So new orders went up, but fewer firms reporting an increase in new orders. Fewer firms or more shipments went up. That was good news. Unfilled orders down. So fewer firms have unfilled orders. That's not inflationary. It's a big drop, 40 to 22. How about delivery times, 41 to 29? So you're seeing the economy continue to reopen. Inventories, fewer firms reporting an increase in inventories. Prices paid went up. That's just kind of almost a surprise to me. Prices received, fewer firms or more firms reporting they got price increases passed through, but 80% of firms had price increases. 49% of firms had prices increase that they received. So that tells you there is margin squeeze to these companies. Number of employees, 30% of firms increase their employment, but only 20% of firms increase their work week. So you're not seeing a huge amount of surging demand here from the Philly Fed survey. And as far as any data from Friday, the only thing we've got at least late Thursday now is Japan. National CPI year over year still deflationary, but it moved from negative 0.4 to negative 0.1. So an inflationary move to a less deflationary print. Month over month number went from deflationary to inflationary. And let's see, retail sales in Great Britain month over month down 2.1%, not good. That's core, excluding food and energy. Retail sales down 1.4%. Producer prices in Germany up. I mean, I was surprised we've been seeing that kind of go up and up 1.5%. So a lot of challenges here facing the economy, but the key part is bond market is telling you financial conditions are tightening. Fed is completely unprepared for it, and thanks to the roll-off in the TGA, this reverse repo problem is getting worse. This collateral problem is getting worse. That will further put downward pressure on interest rates, and when you understand that, it puts further downward pressure on equities because this means that there is a shortage of liquidity, and that's how you get another crash in the market. So will it play out? We'll see. It'll be certainly interesting to watch because the bond market is telling you that this party is just about to get started. Anyways, thanks for being fans. Thanks for liking. Again, thanks for subscribing, and we'll be back Sunday, of course, with Sunday night charts. And we'll get into some, I think that show is going to be pretty interesting. Then back on Monday with a macro show, and hopefully we'll have the banking data to take a look at. I'm Steven Van Metre. Have a great weekend. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. Material is not to be construed as recognition or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity, opinions expressed in the video that do not reflect the view of Alice Financial Advice Inc. or Steven Van Metre Financial.